Good morning, everybody. Good morning, everybody, and happy Monday. Today is February 26, 2024. A new week is upon us, and the week is off to a pretty rapid start. Now, this story is not making headlines here in the States, at least not yet, but we've got another bank posting big credit loss provisions for commercial real estate this morning. This time it is once again across the pond in Europe, the Bank of Ireland, ticker BIRG. They posted a pretty good quarter. Earnings were up substantially year over year on higher interest rates. Net interest margin was looking pretty good. Some headlines are really trying to pump those good numbers, but really all of that is getting lost in those loan loss provisions centered around commercial real estate. Here's a couple of numbers. Loss provisions of 403 million euros. That's about $436 million, up from 187 million euros a year ago, or about $203 million. That is an increase of 114% in loan loss provisions, all because of commercial real estate. I've been saying this for a while. We've been talking about it on this channel for, well, really since I started this channel, almost 2 years now, that these buildings are just not worth as much as people are saying. And guys, this problem is so widespread. This is not just a matter of a couple of loans. Every office building in the world is worth about half of what it used to be. There might be some extreme examples and some really, really prime locations that are doing a little bit better than that. But there's a lot of examples of really lousy locations that are doing a whole heck of a lot worse than that. And this is not a U.S. problem. This is a global problem. And while that's all going on in office, we've got the same thing going on in retail, maybe to a lesser extent. But with more people shopping online, we've got way more stores than we need, something we've known about for over a decade. And yet we just keep doing this extend and pretend, push the debt out, refinance into a lower rate, and then hope that problem never really gets here. Well, now we've got higher rates and the problem is here. And on top of that, even multifamily residential is starting to show cracks as it's being overbuilt. I know there's a lot of talk about this housing shortage, but you know what? People can't afford higher rents. If they can't afford higher rents, those buildings, well, they go belly up. So Bank of Ireland is the latest. Their stock is down 11% on this news. Also, we've got real estate website Adam is out with a report that says 97% year-over-year increase in foreclosures for commercial real estate. And more alarming, that number was up 17% month over month in January. 17% monthly. That is an astonishing rate of increases in foreclosures in commercial real estate. Remember, guys, this risk, this commercial real estate phenomenon, it is concentrated in small banks and retirement accounts. That is who is going to take the hit from commercial real estate. Some of these REITs are going to go down. Some of these real estate and private equity firms are going to go down. But a lot of them are just going to walk away from their debts and then take that money and buy back the same buildings for pennies on the dollar. It is the small bank customers and it is the pension funds and the retirement plans that are really going to take that hit. And case in point, we had the New York State Common Retirement Fund, or NYSCRF, loaded up on New York Community Bank stock right before they reported their recent earnings, their quarterly report. That trade didn't go so well for the New York State Common Retirement Fund, as that stock has cratered almost 60% since reporting earnings. Also, on my live stream Friday afternoon, I talked about how insiders were selling. The billionaires are dumping stock while retail FOMOs into zero DTE calls and everybody's just, oh, NVIDIA, bro, buy, load up, YOLO. Well, the big dogs are selling. The billionaires are selling out. All Friday in my afternoon live stream, I talked about how guys like Bezos, who else? Jamie Dimon selling JP Morgan for the first time. Mark Zuckerberg was selling. Well, this morning, you can add the Walton family, the founders of the Walmart empire, to that list, because 3 of the heirs to the Walton family empire are currently dumping Walmart stock. They dumped $4.5 billion worth of Walmart stock. And you know what? That stock, it's up this morning because retail's buying. Congratulations, exit liquidity. If you're buying in this market right now, you are exit liquidity for billionaires and founders. Good luck with that one, guys. And WTF is going on with cocoa prices. Now, that is not a commodity or a financial instrument. That's a particularly interesting topic. It's not so like, oh, what's going on with cocoa? It's one of those most random of things, but its price is exploding. There's a combination of drought and disease that's hitting a couple of key countries, and the price of cocoa has gone vertical. It's up again this morning. It's showing no signs of stopping. Now, obviously, it's going to come back down eventually. But the thing about cocoa beans, they grow on trees, and those trees take about 5 years from seed to fruit-bearing maturity, which means this disease and drought that's ravaging and killing crops right now, it's not like they're just going to bounce back in the next season. So it looks like get used to higher chocolate prices for the foreseeable future. Domino's Pizza reported quarterly earnings. They were pretty good. The stock is up. It was a beat, but there's some numbers in there that don't really look so good. I mean, the market right now is ignoring the ugliness and the stock is rallying, but we're going to look a little bit behind the numbers on Domino's and show inflation has gotten to people, and the solution to higher prices is higher prices, as always. So much going on in the world, so little time. Why don't we shrink my big melon of a head and let's get into markets? Guys, don't forget that like button while we're doing that. And of course, if you're new to the channel, hit that like button, hit that subscribe button, that notification bell, and have your coffee with the melon heads every morning. Right now, the Fear Greed Index is back into extreme greed territory at 78. It's been up here in the 70s for a couple of months now. This market is frothy, to say the least. The S&P, though, this morning is up again just 2.6 points, about 0.05% higher ahead of the opening bell. The Dow is up 14 points, about the same percentage, just marginally higher this morning. And the NASDAQ is up 22 points, or 0.12% higher. So the NASDAQ is leading the way, although stocks are having a pretty dull morning. The DXY, meanwhile, is selling off this morning. Looks like the weaker dollar down 22 basis points, back below 104, currently at 103.71. So a weaker dollar will put some upward pressure on asset prices this morning. Looking over at the bond market, we got slightly lower yields on the long end of the yield curve, slightly higher on the short end. The 30-year is at 4.364. That is down 1.5 basis points. The 10-year is at 4.251, down about 1 point. The 2-year is at 4.690, unchanged this morning. And the 1 month is higher by a fraction of a point at 5.4 even. Looking over at commodities, gold is at $2,040. That's April futures are down $8.65 this morning, about 0.4% lower. May silver futures getting crushed right now, $22.81. That's down 37 cents or about 1.6%. It's interesting that we see weaker gold, weaker silver because we've got a weaker dollar this morning. That doesn't usually happen. Platinum is down 2.6%. Palladium is down 3%. So all the metals are getting in on this sell-off here. Crude oil, though, is just marginally positive at 76.64 for April WTI futures. That's up about 15 cents. So let's take a look at the big one this morning. The Bank of Ireland stock sinks as provisions for commercial real estate rise. Get used to this story, guys. We are going to see this over and over again this year. It is these small banks that you really need to worry about with commercial real estate. And today it is Bank of Ireland. Let's look at the numbers. Bank of Ireland became the latest to flag worries about commercial real estate as it announced higher provisions linked to the sector and saw its shares tumble on Monday. Alongside annual results, Bank of Ireland, ticker BIRG, reported that its underlying net credit impairment charge climbed to 403 million euros or $436 million US in 2023. That's up from 187 million euros in 2022. That's an increase of 114% for credit losses. This charge reflected loan loss experience in the period and additional management adjustments to address potential risks, primarily in commercial real estate, said Miles O'Grady, the bank's group chief executive, in a statement. The bank expects an impairment charge in the low 30 basis points for 2024. Bank of Ireland shares slumped 11% and are now down 21% over the last 52 weeks. It was the worst performing component of the Stocks Europe 600 on Monday. Now, that's one headline that shows, hey, this stock is getting crushed, and here's why: commercial real estate losses. Now, check out the same bank on the same day, but a different outlet's take on it. This one is in Reuters. Bank of Ireland to triple shareholder returns. It's the same story. It's the same bank on the same day. Look at how this one, doesn't this sound a little different? Doesn't this just make you want to run out and buy Berg stock? Well, that's what Reuters is saying this morning. Bank of Ireland, or Berg, will more than triple returns to shareholders for the second successive year. The country's largest lender said on Monday after higher interest rates helped it to nearly double full-year profit. This is the same story, guys. They're like, whoa, tripling returns, doubled full-year profit. But the stock is down 11%. This just goes to show you how the press can just make this news say whatever they want. We saw the same thing in the immediate aftermath of NVIDIA's earnings when initially the stock sold off, and I believe it was Bloomberg was saying, "Oh, the guidance fails to impress," and then 5 minutes later, NVIDIA blows away guidance once again. Same story, a few minutes apart, and yet the market swings on the change in the narrative. Ireland's highly concentrated banking sector makes more of its profit through interest revenue than European peers, with lenders enjoying a surge in net interest income since the ECB started increasing rates 18 months ago. Bank of Ireland's pre-tax profit rose 92% to 1.9 billion euros in 2023. The company plans to return 1.15 billion euros to shareholders. 634 million of that will be in dividends, the rest through share buybacks. The bank expects its strong capital to continue in 2024, with distributions again comprising dividends and share buybacks. Its net credit impairment charge doubled to 403 million euros, which the bank said included adjustments to potential risks, primarily in commercial real estate. Oh, there we go. In the sixth paragraph, we finally get to the big news, the doubling of impairment charges, the one that's got the stock down 11%. They mention it in the sixth paragraph after all the good stuff. Finance chief Mark Spain told Reuters there's no evidence of material stress across the bank's loan book, other than the fact that we just doubled our loss provisions, and that the charge related to commercial real estate is us getting ahead of any potential future problems. Don't you love the soft language here? We're just getting ahead of any potential future problems. Never mind the fact that every building in the world is losing half of its value. Nothing to see here. Move along. Bank of Ireland stock down 11.3% this morning. Just absolutely getting crushed here. And this will not be the last bank, guys. We got a lot of U.S. small banks are really exposed to this one. So we'll be hearing more about this. And here we go. This is in the Commercial Observer. This story, it's from a couple of days ago, February 23rd. U.S. commercial real estate foreclosures up 97% from last year, 17% month to month. Spike signals a revitalization, the Adam report shows. Now, I took my glasses off because I'm about to smack myself in the forehead after reading that byline. Let me just read that to you once again. All right. You got the numbers there. Foreclosures up 97%, 17% month over month, which if you compound that monthly is something like a 600% annual increase, something like that. And then they're saying the spike signals a revitalization, according to the Adam report. Do you feel revitalized after hearing that foreclosures are up 95%? I think we have two very different ideas of what vitalization and revitalization means, Adam, because that's not what that sounds like to me. A new report from real estate data firm Adam shows a significant annual jump in U.S. commercial foreclosures in January. The Southern California-based company counts the number of commercial properties with at least one foreclosure filing entered into its database each month and found 635 in January of 2024. That is 97% more than the same month last year and 17% more than December of 2023. The report put an optimistic or even bullish spin on the jumps. The 97% year-over-year increase signals a revitalizing market that is navigating through the long-term economic shifts following a global event, adapting with resilience and strategic adjustments to new commercial realities, the Adam report reads. So really, guys, these people crack me up. Foreclosures have doubled in a year, and that's a good thing, really, when you think about it, because it shows revitalization and resilience. And good God, these people. It's a good thing. Don't worry. Honey, the house burned down, and that's a good thing. It really shows how responsible I am because I'm telling you that the house burned down. You see? I mean, really, you should be thanking me. That's how this works. Don't recommend you try that. That's not really how this works. Moving on, check this one out. Big pension bought up NYCB stock right before it tumbled. A New York City pension bought up shares of New York Community Bank shortly before shares of the regional lender tumbled and slashed investments in two Chinese companies. New York Community Bank, the New York State Common Retirement Fund, added to its stake in NYCB in the fourth quarter of 2023, not long before shares dove at the end of January 2024. During the quarter, the pension also sold material amounts of Alibaba and Tencent Music and trimmed its holdings in Palantir Technologies. Why is it always pensions? Whether it's commercial real estate, securitized BNPL loans, whatever toxic garbage Wall Street is selling, or in this case, shares of New York Community Bank. Why is pension funds always the destination, the final dumping ground of all of this crap? It always ends up in the pensions. There's just too much moral hazard in our pension system. The guys managing these funds obviously do not care, because anybody in the world running that pension in New York could have looked at New York Community Bank and then could have looked at Signature Bank and said, Signature Bank failed last year. They were the largest holder of those rent-controlled apartments. New York Community Bank was the second largest holder of those rent-controlled apartments. New York Community Bank bought up everything that was left from Signature Bank except those rent-controlled apartments because they knew that was toxic garbage, and yet nobody at this pension fund flagged this bank as a risk, and they put retirees' money into it. I'm sure it's got nothing to do with whining and dining or trips to the strip club or who knows whatever to grease the wheels to get this job done. New York Community Bank stock, just a reminder, January 30th went from about $10.52 what it's trading at today. This bank is toast. Also, check this one out from Insider Tracker on X. This is an excellent Twitter feed, guys. You should be following this one if you're not already. Unusual insider trade alert. The Walton family just sold $4.5 billion worth of Walmart stock, ticker WMT. Each sibling, Jim, Alice, and Rob, sold $1.5 billion. The trades were reported after market close on Friday, most likely to avoid media coverage. There's that Friday news dump. What don't they want us to know? Well, Insider Tracker, they don't want us to know that they're selling stock to retail, that while everybody FOMOs into this market chasing all-time highs, the big money is taking advantage and selling out, which means the money is transferring directly from the retail trader's pocket to the billionaire's pocket, while the billionaires tell us it's the best economy ever. Walmart stock, though, guess what? People are buying it again this morning, up 1.57%. ahead of the opening bell. The founders of the company just sold $4.5 billion worth of stock in this company, and it's up 1.5% this morning. That is this market for you, folks. And looking over at this one, this story, I tell you, nobody cares really about cocoa beans until it becomes a big thing, because cocoa jumps to a fresh record on persistent supply fears. This thing is just going straight up, and it's not slowing. Futures climb added to the biggest weekly gain since 1999, and the rally threatens to increase costs for chocolate makers. Thank God we got this one in before Valentine's Day. Cocoa's rally shows no signs of slowing, with prices surging to a fresh record in New York on mounting fears about supply shortages. Futures climbed as much as 4.6% on Monday after capping the biggest weekly jump since 1999. Prices have soared as drought and disease ravaged crops and key West African producers, threatening to raise costs for chocolate makers that risk being passed on to consumers. And Hershey's has already told us they're either going to shrink their chocolate bars or raise their prices because of this phenomenon. There are persistent signs of tightening supplies from key exporters. Bean arrivals at ports for shipment and top grower Ivory Coast are running about a third behind last year's pace, while Nigerian exports were down in January. And what does that look like on a chart? Well, take a look at this one. This is cocoa futures. Now, this, I believe, is U.S. dollars per ton, I think is the measurement here. But at the end of November, these cocoa futures were about $2,500 per ton. They have almost tripled to $64.50 this morning, up another 3%. And look at what this thing did last week, just going straight vertical. Now, guys, this isn't just a matter of planting more next year. It takes about 5 years for a cocoa plant to mature or a tree to mature to get to fruit-bearing age. So, yeah, the population of the trees takes this big hit from the drought. It's not just going to bounce back next year. It's going to take a couple of years to absorb this. Now, I'm pretty sure this is just going too far, too fast. We've seen this before. I mean, this is exactly what NVIDIA stock is doing. We know it's going to take the elevator down eventually, but it's going to settle higher than it is right now, and it's going to take a couple of years probably to get back to those 2022 levels. Now, check this one out. There's a lot of macro going on in this earnings report from Domino's this morning. Domino's Pizza beats earnings expectations and how it plans to grow more. Now, Domino's is having a pretty good morning, but there's some pretty bad news hiding in this report. Domino's reported better than expected earnings for the fourth quarter as the company continues to see growth despite inflationary pressures. The company posted quarterly revenue of $1.403 billion. That's up 0.8% from a year ago, but slightly below the $1.422 billion that was forecast by Wall Street analysts. So top line numbers, revenue up only 0.8%. Remember, guys, inflation is still 3.4, I think was the latest number, 3.5, something like that. So their revenue numbers, not even their profitability, just their revenue, they have been unable to pass the cost of inflation on to their consumers. That is a big red flag for me. Domino's does not have pricing power. If they raise prices, they don't sell pizza. Otherwise, they would have raised prices more. Now, earnings per share were $4.48 in the fourth quarter. That's up 5 cents or 1.1% from the year-ago period. Again, not keeping pace with inflation. That's better than analyst estimates, though, of $4.38. Still, gross margin for Domino's company-owned stores in the U.S. decreased by 1.6 percentage points in the fourth quarter from a year ago, primarily due to higher costs of labor and insurance, as well as the relaunch of its rewards program, according to the company. So there goes to show you the loss of pricing power. Margins getting squeezed. We have got labor costs rising, insurance costs rising. The cost of a rewards program, which is basically a rewards program, is a subtle way to lower prices without lowering prices. It's a gimmicky thing to do. It's a desperate measure before the prices get cut. The pressures were partially offset by higher same-store sales for Domino's U.S. stores, which grew 2.8% from a year ago, again below the rate of inflation. So those comps up less than inflation, which means less pizza is selling. But same-store sales for the overseas markets were largely flat, again, despite inflation. And the company opened more than 300 new stores overseas, outpacing fewer than 100 new stores in the U.S. So all of this earnings growth, it was just from new stores opening. It wasn't from increasing profitability at Domino's stores. And this is important, guys, because food away from home, last year, Americans spent a crazy amount of money at restaurants, a crazy amount of time traveling. So Domino's should be posting incredible results here. Now, these results are okay, maybe even good. But considering everything that other restaurant chains have been doing and what we've seen in the inflation numbers and the amount of travel spend, Domino's should be doing much better than that. Although, look at the stock right now. It's up 6% this morning on this news. I don't know what the good news is in that Domino's report. I honestly don't know. I look at that. I see margins getting squeezed. I see a loss of pricing pressure. Combine that with Americans who have tapped out their credit card debt. I don't think things look that good for Domino's here, but hey, the market has other ideas once again. And I just want to say thank you very much to Nashville Pasta Man, who says Walton's bought the Broncos and Russell Wilson's contract. So I guess they got to sell that stock to make up for their football expenses. Is that what the Waltons are doing there? I guess. But a very tactical announcement from the Waltons there, Pasta, that Friday news dump. You know, oh, wow, the best week in stock market history. NVIDIA, bro, everything's up. And then very quietly, the billionaires sell $4 billion worth of stock. Quick, while everybody is just passively dumping money into the indexes. Never mind the billionaires that are cashing out. Never mind the fact that you all are being used for exit liquidity. Don't worry, guys. Just pump this market. Good luck with your call buying. Please don't let the fact that every building in the world has lost half of its value. Don't let the fact that the banks are still flashing warning signs. Don't let that scare you. Just YOLO in the calls. What's the worst thing that could happen? Don't answer that. And please, guys, note sarcasm there. Thank you very much, Nashville Pasta Man. I appreciate the super chat, the support of the channel, sir. And thank you, M&J, for gifting 5 channel memberships. And thank you to all of my Melonheads and Magnanimous Melonhead channel members. Appreciate that very much. If you guys were gifted a membership, be sure to thank M&J and also Alex Lieberman, who has gifted channel memberships. Thank you very much, Alex, for doing so. I appreciate that, sir. You are a gentleman and a scholar. And thank you, Steve Woitis, who says, my employer just announced a decrease of 7% of global headcount. Uh-oh. As far as strong and resilient goes, the USA may be the last man standing. I do think the U.S. is probably a little bit better off than a lot of other countries, but emphasis a little. I don't think anybody is going to be spared from this round. The commercial real estate in the U.S. is certainly going to be worse than pretty much all of the other countries, China notwithstanding. China's the only exception there. They're going to get hit harder in real estate than we will. A 7% reduction in headline. There's that strong jobs market again. I mean, we keep seeing that over and over again. The ANAC data is overwhelming that the layoffs are just across the board in the economy. And yet we keep getting these non-farm payrolls that show these amazing growth in jobs numbers. Never mind the fact that they're all part-time jobs offset by loss of full-time jobs. And all we have to do is make a seasonal adjustment here or an adjustment to the way we measure the population here, change the way the growth statistics are, and poof, magic jobs appear out of nowhere. And it shows my economic plan is working. Boots on the ground tell otherwise. As case in point, Steve Woitis' 7% reduction in global headcount. Well, Steve, I hope you are certainly not among them, sir, and best of luck to you and your coworkers. Thank you for supporting the channel. So long story short, guys, we got another bank is in trouble this morning, another one in Europe. They are joining New York Community Bank, Azora in Japan, Deutsche Bank and Deutsche Pfandbrief Bank in Germany, and now the Bank of Ireland. In Ireland, this is a global phenomenon, the banking crisis that's going to be caused by commercial real estate. We are still in the early innings of it. We'll be hearing plenty more about that in the months ahead. Thank you very much, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you to all my channel members and Patreon supporters. Appreciate you guys doing that for the channel. Links down below to all that good stuff. Also, hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.